All right, so my next guest marveled at the S&P hitting 6,000. Not that he didn't think it would hit it, but at the time, right, tensions between Russia, Ukraine getting worse. President Trump and Elon Musk with that public spat, and interest rate cut expectations were just pushed out, right? Many were saying none this year. So let's bring in Kobeissi, the editor-in-chief, Adam Kobeissi. And Adam, you know, it's clear that that means that Wall Street likes climbing the wall of worry. Isn't that the very definition of it?
It does. I mean, look, we've had every possible reason to fall, every headline you can possibly think of, including the fight between Elon Musk and Trump. And everything has been bought. Even Tesla stock is now up 23% since last week's low. So I think right now the market has a lot of momentum. Sentiment is extremely strong. The name of the game this year has really been sentiment. We've seen the fundamentals move in every direction. Regardless, if the market has strong sentiment, if inflows into equities are strong, I think we're going to keep rising, and that has been our view, and I think we will see probably
so essentially
all-time highs.
Follow the money. I mean, because sentiment is one thing, but where the money goes is what people really feel.
Absolutely.
I think that's why those betting sites do so well also.
Well, and the other thing is, hedge funds were selling equities at a net basis for the last 3 months. In May, we saw a record net inflow into global equities by hedge funds. So a lot of this institutional capital that was sidelines is now actually starting to come into the market, albeit near all-time highs. I think we do have more rocket fuel to push stocks higher here.
You caught my attention with this post today after the CPI number because, okay, 2.4 inflation is much higher on the basic necessities. And this is the problem, right? The average American feels utilities, car insurance, meat and eggs doesn't help. We always have these issues with animals. Car repair, that's the one, you know, but it goes on and on and on and on. But what happens? I mean, what does this put, for instance, the central bank, because, you know, making someone pay 23% on their credit card doesn't bring these prices down.
So this is the tough part. A lot of the things that people follow on a day-to-day basis are still increasing more than 2.4%. And by the way, we actually have compounding inflation because the last 4 years, we've had elevated inflation above the 2%, well above the 2% target. Right. So we're building inflation on inflation, just at a slower pace. I think right now, Americans just feel a little bit uneasy with where inflation is going to go. If you look at inflation expectations, they're elevated. Will that materialize? It's probably too soon to tell. But I think if we can see inflation move sustainably towards 2% and stay there, then you start to open the door for cutting rates. I think right now it's not a bad spot to wait and see. Maybe wait until July or September to start cutting and just see how the data reacts. But I think we're getting towards that point.
All right, let's go over a summary of your analysis here, starting with the S&P. You're bullish right now. That means where we are now, that suggests maybe we start to make new all-time highs.
Right, so we're looking for 6,100 now on the S&P and even higher, potentially new all-time highs. Like I said, I mean, you're just seeing a lot of inflows from the institutional side. You're seeing market sentiment is extremely strong. And our strategy has been, in a market like this, you need to play the trend, whatever direction that trend has been. In April, it was down.
The trend is your friend.
The trend is your friend. And what you need to do is have a tight stop. So we keep raising our target. We're raising our target, but keep your stop tight, because if we do see a trend reversal, you're not going to get burned to the downside. But on the flip side, you know, it costs a lot of money to be short into a market like this. So
yeah.
We're playing along with a tight stop.
So speaking of trends, right now the trend in the last week has been West Texas Intermediate up, the energy sector up, but you're bearish.
So I think, look, we're nearing 67, 68 now. I think President Trump has made it clear lower energy prices are his number one motive or driver of lower inflation. So I think as we start to near that 70 mark, with OPEC now raising production as well, you're going to start to see more comments from Trump kind of limiting outbreaks in oil prices. There's also a lot of the geopolitical tensions are now priced in. We could see more progress between Russia and Ukraine help push down prices a little bit.
Right.
So we're not buyers of crude oil here for sure.
Gold miners are, you know, at the beginning of the year, last year, the miners, you know, gold went this way and the miners are sort of this way. But the miners have gone parabolic lately. Are you still buying?
They've done great. We're still long gold. I know you always call me the youngest gold bull on Wall Street. I'll still hold that title because you know what? I think we're going to 3,500 plus on gold and even higher from there. It's just the primary global safe haven asset, that and Bitcoin. And I think with Treasuries now kind of leading into our last position here, with yields rising so rapidly, investors don't want Treasury bonds.
So let's talk about that, because you think yields are going to go up and you're bearish on bonds. I'm bearish on bonds because I just don't think, I'd rather see people invest other places, but I feel like yields aren't going to go up much higher than they are now.
I think we'll still see the 10-year approach cross above 4.5, even towards 5% if things get sticky with inflation.
Right.
But I don't think we're at the place right now where we're going to see a straight line lower in yields. I think we do see higher yields for now. The Fed is clearly not going to cut rates this month, or probably not the next month, and maybe not even September.
Right.
And I think for now, the path of least resistance really is higher for yields, lower for bonds. And I think that will continue to be the case.
Real quick, I got less than 30 seconds. I saw a note where you really talked about Apple, right? I'm used to your macro calls. I didn't know you did those sort of calls. Was it a cautionary thing, or?
Well, look, I mean, Apple. The whole story about Apple's AI. This week, everyone's talking about their conference where they said, "Oh, over the next year, we'll start rolling out more AI." But I think every single time that Apple dips in the wake of both the AI situation as well as the trade war situation, the dips have been bought. Apple has proven to be one of the best innovative companies in the world. They're always ahead of the trend. Even if they seem to be behind, they come out with a product that everybody adopts, especially with the ecosystem they hold. So I think, we're actually bullish, and we've been buying the dips, and I think that will continue to be the case.
Great seeing you, my man.
Thank you,
Always
Charles.
great seeing you. You got to come more often, though.
I will.